More and more people with money are predicting that there's going to be economic pain ahead. How do I know? Take a look at this Market Watch article. It's titled, "We've Never Seen This Before. Banks are sitting on tons of cash, sitting idle, waiting for the right opportunity." But here's the interesting part. It's not just banks that are doing this. It's high net worth individuals as well. Take a look. High net worth individuals are putting more money into short-term cash allocation, checkings accounts, savings accounts, and CDs. And it's not just the fact that people and institutions with money are starting to save money. It's the rate at which they're saving money. Take a look at the statistic. High net worth individuals stored 34% of their wealth in cash and cash equivalents in 2022, which is up 10% from 2021. Now you have to ask the question, why are people with money, why are banks, why are investment funds starting to store more cash? Because if you think about it, cash doesn't do anything. I mean, if anything, cash loses value. If you put $100 in your back pocket today and you left it there, that $100 is going to have less buying power a year from now. Why? Because inflation exists. Inflation means the prices of things are going up. And so if the prices of things are going up, that $100 has less buying power. So why are we seeing more and more banks, more and more high net worth individuals sitting on cash, storing cash, and in some instances keeping this cash in places where it's not generating any return? Because when a bank is storing cash, that means they're not getting any money. They're not getting any return because banks are in the business of lending money. And when they're storing cash, that's dead money. That's a dead asset that's not producing a return for them. And banks want their money to be alive. They want to lend it out and continue to get a return. So why are banks doing that? Well, banks are getting worried about making loans. They're worried about what's happening in the economy, and they're worried that people might not be able to continue making the loans in the future. And for high net worth individuals, they're looking at what's happening in the economy and they're saying, well, if I keep my money in cash or if I keep my money in a CD, that is a better return for me right now than me going out and investing the money, because there's risk with me investing the money. And if I'm seeing potential headwinds against the economy, I'm not going to want to take that risk. If I think that we might see the stock market fall, we might see the real estate market fall, I'm not going to take my money that's sitting in my high interest savings account paying 3-4% interest, or my CD paying 4.5% interest, take that money out and risk it where maybe I'm going to get a 7% return, but maybe I might see this money fall. And if the opposite was going on, if people said, I think the economy is going to boom, I think that we're going to see a lot of growth in the markets in the coming years, no one's going to want to keep their money in a high interest savings account or in a CD where you're earning 3-4-5%, because you're going to say, shoot, I'm going to get 10, 12, 15% returns in the markets. Why would I want to keep my money into these high interest savings accounts or CDs or checkings accounts or savings accounts? And that would entice people to want to pull money out. It would entice banks to want to lend money because you think that the economy is looking stronger tomorrow. But what we're starting to see happen is a change in sentiment. And it's not just what people feel, it's what people are doing with their money, because we're seeing more banks, we're seeing more high net worth individuals that are keeping this cash aside just in case. Now, yeah, at least we're getting some sort of return on our money, but people are looking at the market saying things are expensive. The markets are overvalued. The markets are really kind of struggling to keep up. I mean, the economy is starting to slow down. We're starting to see all these different things happening in the economy. Do I really want to deploy all of my money right now and potentially miss out on opportunities in the future? And this is the question that more and more people are asking. And what we're starting to see happen statistically is more and more people are starting to pad these savings accounts. That way, in case something bad was to happen in the economy, well, now you have this, what people call dry powder. You have this ammunition to go out and buy investments when they start to fall. Even Charlie Munger, who was Warren Buffett's right-hand man, recently came out in an interview and said that he still believes that we're going to see some sort of recession, even if it's just a mild recession in the near future. He went on to say that one of the biggest causes that he believes was going to trigger this mild recession is commercial real estate. What he had to say was, every bank in the country is way tighter on real estate loans today than they were 6 months ago. And the reason why he's concerned about the commercial real estate market is because of all the changes that we've seen happen in the commercial real estate market. We've seen so many offices sit vacant or half vacant because people have been working from home or people have been working hybridly. And now what we're seeing is that in the coming 24 months, we're going to see a huge chunk, upwards of 50% of all of our commercial real estate loans readjust, because commercial real estate loans are not 30-year fixed rate mortgages. Many of them are going to readjust in the coming 24 months. And so now, if you own an office building and your original loan was at 3.5%, and now it's going to come and readjust at 7.5%, that means your payments are going to go up. Now, normally that's not a big deal, because what you would do is you would just raise the rent on your tenants. You would raise the rents on your offices, on your businesses that are renting your office space. But if your offices are sitting half vacant, who are you going to raise the rent on? You're going to push more people out of the office, and that's the big concern that Charlie Munger is saying that he sees coming. And so we definitely have a whole bunch of different red flags in our economy right now. The question is, what's going to happen between now and then? Because currently, we have high interest rates. Currently, the Federal Reserve Bank is saying that they're going to work to continue raising interest rates. But what's going to happen in 12 months? Is the Fed going to continue raising interest rates? Are they going to continue keeping interest rates high? Or are they going to say our economy is slowing faster than expected and we need to start cutting interest rates? We don't know this. And that's where we have all these different question marks as to where the economy is going to go. But unlike previous economic slowdowns, we are still facing high inflation. And so the Federal Reserve Bank has to be much more diligent with interest rates, and they don't have the same flexibility to start cutting interest rates as quickly without any consequences. Because if the Fed started to cut interest rates tomorrow and mortgage rates fell to 3%, you're going to see a huge flood of people into the housing market. If people started flooding into the housing market, home prices are going to go up because now buyers are going to be bidding against each other to buy a home. And if home prices start to go up very quickly, now the inflation problem becomes worse again. So we have all these cyclical issues. Our entire economy is completely tied together, because while the higher interest rates would make home prices less affordable, it could make offices more affordable because the commercial landlords are struggling. This is one of the things that we've been discussing pretty often in Market Briefs. Market Briefs is my free daily newsletter where my team is breaking down what's happening in things like the housing market, the economy, the stock market, the global economy, and the cryptocurrency market into a fun, witty, and easy to read email. If you have not joined Market Briefs yet, I highly recommend you do so, because number one, it's free, and number two, well, if you don't love it, you can just unsubscribe so you have nothing to lose. So if you have not joined Market Briefs yet, you can go to briefs.co/market. That's briefs.co/market. And I also got the link for you down in the description below. But if we quickly go back to the topic of commercial real estate loans, here's what Charlie Munger had to say. Charlie Munger said that the commercial property loans held by U.S. banks are now going to be deemed, quote, bad loans, or many of them are going to be deemed bad loans because of declining property values, meaning commercial real estate prices will be falling, people will have more debt, the commercial landlords will become underwater, and they won't have the ability to continue making the payments, which is why he says that they will be called, quote, bad loans. But it's not just commercial real estate. We are seeing different headwinds in different parts of the economy. Like if we take a look at the Airbnb business, which is a big part of the travel business now, Airbnb has been seeing their demand for rentals start to fall. And there's a couple of different factors having to do with that. Number one is when people were completely virtual, people wanted to travel more, because now you could work from anywhere in the world and just enjoy and work. But now we're starting to see that shift where more and more employers are saying you got to get back into the office. If it's not 5 days a week, maybe it's 4 days a week, maybe it's 3 days a week, where more and more employers are asking employees to get back into the office. And if they're not asking, they're demanding. And that's where now people don't have the same ability to travel. They don't have the same ability to work in different parts of the country like they could before. That's one factor that has been impacting the Airbnb business, which hurts travel, which hurts different types of spending. But then in addition to that, we're also seeing just less demand for travel. Part of the reason why is because the cost of travel has gone up so much, along with the cost of everything else. We've seen grocery prices get more expensive. We've seen housing costs get more expensive. We've seen cars get more expensive. We're starting to see some relief in the car market, but in general, cars are still way more expensive today than they were a few years ago. And so when you have the prices of things constantly rising, eventually people are going to have to say, you know what, either I'm going to have to go into debt to finance this vacation, or I'm just going to cut back on my vacation. Maybe we go for a shorter vacation, or maybe we just go on this vacation next year. And that's one of the things that Airbnb is starting to see, that the demand for travel is starting to fall. Part of it has to do with the changing work environment, and part of it has to do with just the rising cost of travel. Flight costs have gone up, restaurant costs have gone up, and so it's much more expensive if you have a family of 4 or even 2 people and you're going out and traveling. The cost to go out and travel is getting much more expensive. And if it's not Airbnb, you could take a look at what Nike is saying. Nike recently came out and talked about their latest earnings, and what they were talking about is how their profits have been impacted based off of what's happening in the economy. Here's what Thomas Monteiro, a senior analyst at investing.com, had to say about it. He said, Nike's latest earnings report makes it abundantly clear that the United States economy is in fact facing considerable headwinds, which is a bit of a cold blow after the recent very positive GDP figures. I think the main takeaway here is that investors should take this threat seriously going forward. Now you're probably wondering, what were the factors that hurt Nike's profitability? Well, it was the higher inflation causing their costs to go up, but then also second, the inability to continue raising prices of their products and also having to cut some of the prices of their products. Let me show you. Nike's gross margins were impacted by, quote, higher product input costs and elevated freight and logistic costs, higher markdowns, and continued unfavorable changes in net foreign currency exchange rates. What does that mean? So they had the issues of higher inflation. They had to pay higher money to produce their products, ship their products, and then they had to have higher markdowns on their shoes to continue getting people to keep buying their shoes and stuff. And then third, they had the foreign exchange issues. So what does all this mean? Well, we still have a lot of different factors that are coming through together in our economy. We're still facing the impacts of the high inflation. We're starting to feel the impacts of the higher interest rates, while it looks like interest rates are going to continue to go higher. And these two things together are playing an impact in the economy, and people's spending ability is starting to change. We're seeing people's spending ability start to go down in certain areas that are more discretionary, because your Nike shoes are more of a discretionary item. Travel is more of a discretionary item. You don't need it to survive. And we're starting to see people's spending abilities and habits change because of what's happening in the economy. And this is where understanding that changes in the economy like this, they start off slow, but then it really just can be a domino. If something big were to happen, it can completely flip the sentiment and it can change the trajectory of the economy, which is why your job is really just to be prepared and to understand what's happening. Now, of course, we keep you updated on market briefs, but your job to be prepared means 2023 is not the year for you to go out and finance a new truck. 2023 is the year for you to get financially smart and then continue building your financial education and put money aside to, number 1, protect you against an emergency, and number 2, to be able to capitalize on opportunities that might be coming your way. CNBC put out a really good article titled Financial Experts Share Their Greatest Money Regrets, and they all have one thing in common. And I think this article really explains very well the money regrets that people have in their 30s. So I want to go over the 5 money regrets that CNBC talks about here because, well, I think these are really powerful ones. Let me start with number